Good morning, students. Myself, Sunil Kumar, teaching accountancy in Cambridge International School, Dasua. Hope you all are enjoying e-learning program of Cambridge International School, Dasua. Dear students, as of now, we have done 20 basic accounting terms, which is very essential to understand the accountancy in grade 11. Today, we are going to start chapter number 3, that is Theory Base of Accounting, Accounting Standards, and IFRS. First, we will cover the theory base of accounting. In theory base of accounting, our first topic is GAAP. GAAP stands for, that is GAAP. GAAP stands for Generally Accepted Accounting Principles. Generally accepted accounting principles are the set of rules and regulations through which firms and corporations prepare and present their assets and liabilities and incomes and expenses in financial statement, that is profit and loss account and the balance sheet. It is also called language of accounting. In India, we are following Indian GAAP. Here, first we have to understand what are accounting principles, which are universally accepted and on the basis of which accounting is done. So, the first question arises, what are accounting principles? Accounting principles are the basic propositions generally accepted by accountants as a set of accounting principles based on which transactions are recorded and financial transactions are prepared. These principles are classified into two categories. First, accounting concept and accounting conventions. So we have understood what are accounting principles. Accounting principles, these are universally accepted rules which are followed by accountants in preparing accounting. Now here we have to understand accounting principles are divided into two parts, that is accounting concept and accounting conventions. Accounting concepts are basically the assumptions which accountants of the firm follows while recording business transaction. It is basically assumption. We assume something, that is called accounting concept. On the other hand, accounting conventions are the methods or the procedures which are followed by accountant to give a true and fair value of the financial statement. In accounting, there are three concepts or assumptions. The number one, going concern concept or assumption. This concept assumes that business will have a long life and will not stop in near future or be sold in immediate future. Companies that are expected to continue are said to be a going concern. Going concern, if you are going to open a business, you should open that business with a mind that it will not going to be closed in a near future or sold in an immediate future. This concept is called going concern concept, that business will never stop in future, near future. Second concept is consistency concept or assumption. This concept means that accounting method once adopted must be applied consistently in future. Also the same method and techniques must be used for similar situation. Means once accountants adopt one method of doing accountancy, they should follow that method in future and they should not change that method or principles in near future. But if for any valid reasons accounting policy is changed A business must disclose the nature of change, the reasons for change, and its effects on the items of financial statements. So business should not be so rigid that once they have adopted certain set of principles, they are not going to change it. Business has this liberty that they can change the set of rules they have adopted if business is required so. And the third concept is accrual concept or accrual assumption. This is the most important assumption of accountancy. According to this principle of accounting, revenue, that is income on sale, is recorded in the books of accounts when they are earned, not when they are received in cash. And expenses are recorded when they are incurred and not when they are paid or settled. It means, let's understand this concept with an example. Let's say a business purchased a machinery of rupees 1 lakh and has not paid any amount against the purchase. According to this concept, business has to record in its books the value of machine, that is 1 lakh, whether they have paid cash against it or not. In the same way, if the business sells goods of rupees 20,000 and has not received any cash against the transaction, then again, according to the concept, they have to record the transaction in the books of accounts. It means whether business receives cash or not, they have to record all the transaction in the books of accounts. According to this concept, a fair value is received or arrived by the accountants. This is all. Thank you for listening it patiently. Tomorrow we will back with rest of the accounting principles. Till then, stay safe, stay healthy, and stay at home. Thank you.